Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Capital Southwest Corporation quarterly report. Capital Southwest Corporation is a business development company that specializes in credit and private equity investments in lower middle market companies. The firm provides various services and invests in different types of businesses, including the firm invests in growth financing, bolt-on acquisitions, new platform acquisitions, refinancing, dividend recapitalizations, sponsor-led buyouts, and management buyout situations. It also makes equity co-investments alongside debt investments, up to 20% of total check. Capital Southwest Corporation focuses on investing in specific industries such as industrial manufacturing and services, value-added distribution, healthcare products and services, business services, specialty chemicals, food and beverage, tech-enabled services, and SaaS models. Within these industries, the firm seeks to invest in energy services and products, industrial technologies, and specialty chemicals and products. The company's investment structures include unitranche debt, subordinated debt, senior debt, first and second lien debt, and preferred and common equity. It typically invests between $5 million to $25 million in securities, with a target hold size of between $5 million and $45 million. The firm also has the flexibility to hold investments for very long periods in its portfolio companies. In addition to making direct investments, Capital Southwest Corporation allocates capital to syndicated first and second lien term loans in the upper middle market. It prefers to take a majority or minority stake in its portfolio companies and may invest through warrants. The firm also takes board participation in its portfolio companies. The past year has seen a slight increase in Capital Southwest Corporation's stock price, with changes ranging from minus 1.07% to plus 6.64% in the last 52 weeks. A key factor contributing to this growth is the company's strong underlying earnings growth of 15.6% over the past year. One significant event that spurred an increase in CSWC shares was its strong fiscal Q3 2026 results, which exceeded market revenue expectations and surpassed analyst estimates. The company reported a total investment income of $61.5 million and a slight increase in net asset value, NAV, per share to $16.75. Additionally, Capital Southwest originated $244 million in new commitments during the fiscal third quarter, investing in 8 new portfolio companies and providing add-on commitments to 16 existing companies. The formation of a joint venture with a private credit asset manager is also expected to broaden the company's lending reach and enhance its ability to compete for a wider range of deals. Furthermore, the successful equity capital raising of approximately $53 million through its ATM program supported the increase in NAV per share. Analyst upgrades, including Lucid Capital Markets' upgrade from neutral to buy, have also contributed to the positive movement in CSWC stock price. Overall, these news events have collectively contributed to a slight increase in Capital Southwest Corporation's stock price over the past year, driven by strong earnings growth, robust origination activity, and strategic partnerships. Net income and profit margins. A shift in trends. The net income of a company has shown an upward trend over the past year, with a significant increase of 22% from $30,316,000 in 2024 to $36,985,000 in 2025. This growth can be attributed to higher investment income and lower operating expenses. In contrast, net income increased by only 11.6% when comparing the 2 years, indicating a slower rate of growth. Profit margins have also undergone changes, with an increase in net investment income margin by 4.3%. However, this is offset by a decrease in income before taxes margin by minus 5.8%. The reasons behind these changes are multifaceted. On one hand, higher investment income and lower operating expenses contributed to the growth in net income. On the other hand, an increase in interest expense and a decline in fee income led to a decrease in profit margins. The divergent trends in net income and profit margins highlight the complexities of a company's financial performance. While net income has shown significant growth, profit margins have experienced a decline. This dichotomy underscores the need for careful analysis and consideration of various factors that influence a company's financial health. The company's financial performance indicates a strong ability to generate cash from its core operations. The net cash provided by operating activities for the 9-month period ending December 31, 2025, was a significant $123,119. This suggests that the company is efficiently managing its day-to-day business and converting profits into cash. However, it's worth noting that the operating cash flow for the same period was slightly lower at $11,900. While this may seem like a discrepancy, it's essential to consider the context in which these figures are presented. The net cash provided by operating activities includes non-cash items such as depreciation and amortization, which can impact the overall picture. Despite this minor difference, the company is still generating positive operating cash flow, indicating that its core operations are financially sustainable. This is a crucial aspect of any business's financial health, as it allows for investments in growth initiatives, debt repayment, and other strategic priorities. The company's debt level and interest expenses have undergone significant changes over the past year. According to the extracted summaries, the total debt increased by 11.6% from $999.2 million to $1.12 billion on page 1. However, a more substantial increase of 22.5% was observed between 2024 and 2025, with the debt level rising from $1,508 million to $1,848 million, page 323. This indicates that the company's debt has increased significantly over time. In terms of interest expenses, a notable increase was recorded on page 322, where it is stated that interest expense has risen by $3,335,000, or 22.7% from $14,717,000 in 2024 to $18,052,000 in 2025. Furthermore, the interest expense increased by $9.6 million, 24.1%, compared to 2024 on page 325. These changes suggest that the company's interest expenses have also seen a substantial increase over time. Overall, it is clear that both the company's debt level and interest expenses have changed significantly over the past year. The increases in debt and interest expenses are likely due to various factors, including changes in borrowing costs and average borrowings outstanding. The performance of various regions in the given period has been analyzed. The West region stood out as a top performer, experiencing significant growth in both fair value and net assets. Its market share increased from 17.3% to 21.8% at fair value, and from 35% to 44% at net assets between December 31, 2025 and March 31, 2025. On the other hand, several regions struggled during this period. The Southwest region saw a decline in market share, decreasing from 20.6% to 18.2% at fair value, and from 41.8% to 36.7% at net assets. Similarly, the Southeast region experienced a drop in performance, with its market share falling from 19.6% to 17.6% at fair value, and from 39.6% to 35.6% at net assets. The Midwest region remained relatively stable, showing minor fluctuations but no significant decline or growth. Unfortunately, the international region continued to perform poorly, remaining very low throughout the period. Management is optimistic about the company's outlook, citing a clear investment objective of generating attractive risk-adjusted returns through current income from debt investments and capital appreciation from equity and equity-related investments. The company focuses on investing in established companies with proven management teams, seeking to fill their financing gap and offer customized solutions. In terms of strategy, management emphasizes partnering directly with financial sponsors, entrepreneurs, and business owners to make investments. This approach allows the company to negotiate favorable transaction terms and equity participations. Management also highlights its ability to adapt to macroeconomic risks and uncertainties, including commodity inflation, geopolitical instability, and trade policies. The company's liquidity position is strong, with adequate funds to support near-term capital requirements. This will enable continued funding of investment activities through existing cash, operating activities, borrowings, and future issuances of debt and equity. Overall, management's outlook suggests a commitment to delivering attractive returns while navigating potential risks and uncertainties. Concerns about inventory buildup and supply chain disruption are mounting. Several industries, including transportation and logistics, industrial machinery, commercial services and supplies, specialty retail, telecommunications, healthcare products, aerospace and defense, and others are experiencing elevated inventory levels. This is a cause for concern, as it can lead to inefficiencies in production and distribution. The impact of supply chain constraints is already being felt by portfolio companies and the global economy due to high inflation rates. Furthermore, changes in trade policies, imposition of new tariffs, geopolitical instability, and increased oversight of credits are exacerbating these concerns. These factors have created a perfect storm that could lead to significant disruptions in the supply chain, resulting in inventory buildup and decreased efficiency. That concludes the financial summary for Capital Southwest Corporation. Feel free to comment below, and I will be happy to answer them when possible.